ABSA Capital, providing financing, risk management and advisory solutions. ABSA Capital, born to redefine.
Talk to us first and foremost about what makes structured finance different in terms of applying rating standards.
Correct. Thanks very much. Maybe just to give you some background in terms of how these structures actually work. So, for example, a bank would basically move assets off its balance sheet into a special purpose vehicle. So, for example, residential mortgages, for example. And they would then raise financing in the market on the back of those underlying assets that they obviously offer as security to the market. So basically, they'll issue a various range of notes underneath that structure and obviously offer a spread above the risk fee in terms of those notes being offered.
All right, we're told that the rating follows a particular process of which there is some sort of an arranger in the form of an investment bank. Could you explain that process to us?
I mean, basically the banks have the relationships with the investors, so they ultimately bring the deal to the various participants in the market. And sometimes, obviously, as I mentioned, banks try to move assets off their own balance sheets, and they use their internal debt capital markets teams to sell those assets to the market.
All right, now also told that there are pools of undifferentiated risks where you look at the portfolio and you will allocate the risk accordingly, whether somebody owns property, has invested in cash, other assets. Just explain to us how you determine what are undifferentiated risks.
And obviously you ultimately look at the underlying assets that you potentially would want to buy and what the reference asset might be it residential mortgages or commercial backed mortgages as well. So, or in the case of receivable securitization where you'd look at the underlying receivables, and for example Edcon's done a receivable securitization recently, so you need to look at the quality of the underlying pool.
And then in terms of the spreads, why do they tend to differ across similar rated securities?
I mean, sometimes it does differ. It depends on the underlying quality of the asset. For example, recently ABSA issued a residential mortgage-backed securitization in the market, and there was a big chunk of subordination below the AAA rated notes. And more recently, there was another note that was issued, and that's priced slightly less than that, and it was quite surprising on the back of that.
And then
it's basically based on.
Go ahead, finish.
Sorry, it's based on underlying investor appetite and what they deem the quality of the specific book to be.
Yeah, I'm in a rush. I'm moving ahead swiftly here. Jason, what advantage does structured finance have over traditional corporate credit instruments that are also being used?
No, I mean, what's nice in structured finance is that as an investor, you have hard security of a particular asset that you're looking to provide funding for. For example, I mean, normally you provide loans to corporates on an unsecured basis. So by moving into a securitization world, you're actually getting a look through to the underlying assets.
There's lots of talk about Regulation 28, its impact on the pension fund industry. Your views?
Yeah, there's definitely deep dissonance from our perspective in respect of Regulation 28 looking to further entrench the role of rating agencies in respect of arbiters of credit risk. So and there's concerns around the fact that it's making investors lazy. Investors need to do their own homework in terms of assessing credit risk. And I mean, credit rating agencies are inherently conflicted. I mean, they receive the underlying income stream from the arrangers and the borrowers. And they obviously aren't fiduciaries at the end of the day as investors are.
All right, Jason, we have Andrew here who's our guest host, and he'd like to raise a few points.
I think Jason quite correctly touches on the issue of conflict of interest, and I think that the rating agencies, it has to be the definition of a conflict. You get paid to give a rating to an instrument. Very often they're instrumental in the creation of that instrument so that it comes out with the rating. The other thing is around perception, and I'd like sort of Jason's views on that, is that too often opinion is treated as fact in these instances. Is if you look at the can of the product that they're actually putting out there, is you see that they say that the assumptions that they make are valid at a point in time and that those assumptions are their opinion. Mm-hmm. And if those assumptions change, as was the case in the credit crisis, and fall apart, is a lot of their models were way too optimistic. And when it comes to the pension fund space, surely this has to be a big concern.
Exactly, and that's why I'm particularly saying that entrenching credit rating agencies as a authority of power is really not a good thing at all. Ultimately, it's an opinion at the end of the day. It's important that investors do a thorough due diligence and do their credit analysis themselves when looking at these instruments and before they actually buy it. And that's the main reason why we had this blow up, where investors were just looking at the credit rating of a particular asset and they're saying, fine, it's AAA rated, nothing's going to happen, and ultimately things blew up.
Okay, what we know, Jason, is that, the regulatory environment may be shifting in South Africa, but it's also being influenced very strongly by events internationally. Basel III and new rules on capital adequacy, new rules on scrutiny of assets, and new rules on risk management. How's that going to impact on structured finance?
Well, we'll probably see a lot of more deals in the South African market because particularly Basel III is going to make it a whole lot more onerous for banks. I mean, they're going to have to hold a lot more capital for deals or transactions that they lend money to. So there's going to be probably quite a flood of new transactions coming to the market, and it's more important that we actually get and deal with the fundamental issues.
All right, ultimately, what does a rating mean?
So basically, a rating is an assessment of credit quality. So it ranges from AAA right down to, triple B minus, which is deemed investment grade. So it's deemed your ability to repay and what your credit quality is.
Okay, and in terms of the volatility of the ratings, Andrew's referred to credibility.
Yeah, the problem is with the credit rating agencies, they have this view that investors want rating stability. So they try to look through cycles, things go bad, they don't take forward-looking views, they don't actually adopt changes when things go bad. So in my view is that investors really do want rating volatility. So if something changes from 1 month to the next, it's not a problem. It's assessing and signifying the underlying credit risk that's residing in that particular structure.
What sort of scenarios do you apply in terms of managing the stress or preempting the potential stress that an asset could enter into going forward?
There's various things. Pertinent to residential mortgage-backed securitizations is ultimately what your recovery rate might be on a property. So, for example, if that whole structure had to default, what's your ultimate recovery rate going to be for you as an investor?
And then finally, if you could just explain to us the transparency of the system. There is a sense that ratings agencies use a lot of smokes and mirrors.
They do, and we've got a lot of dissonance around that as well. Ultimately, if one wants to bring credit rating agencies into regulation, they need to be assessed. What are their revenue streams? What are their processes? What are their incentives? So there is a lot of smoke and mirrors, but ultimately, the view is that, to a certain degree, ratings are made up.
And then also, Jason, just before we leave, I'm a woman, I'm allowed to change my mind, so this is the final question. A lot of focus right now is on sovereign debt issues and the credit ratings of nations, and that's what we're talking about. We're not looking at corporates very much, we're not looking at assets that people are trading in terms of trying to spread their investment. Where is there this disconnect, and how can somebody who's looking at South Africa, wanting to invest in South African securities or wanting to invest in South African equities or whatever asset class they want to look at, do they need to look at the broader picture or can they focus at the micro picture?
They always look ultimately through to the underlying rating of a particular country that they'd like to invest into. Obviously they're comparing it to the US's AAA rating, whether or not that is valid or not.